Hello everyone, welcome to week 2 lecture videos. Our today's topic is interest rate risk part 1. We will continue to discuss interest rate risk part 2 next week. We will be covering chapter 8 today. So today we have a couple of learning objectives. Now, first of all, we will start our discussion with an introduction to interest rate risk. We will see the movement of interest rate changes over a time period, and then we will discuss the two models to measure interest rate risk. One is repricing model, another is maturity model. We discussed last week that while performing their asset transformation functions, financial institutions often mismatch the maturities of their assets and liabilities. In doing so, they expose themselves to interest rate risk and eventually the risk of insolvency. For example, in recent years, a large number of non-bank depository institutions have suffered economic insolvency. So economic insolvency means the net worth or equity of their owners has been eradicated due to major movements or shift interest rates. So all financial institutions tend to mismatch their balance sheet maturities to some degree, and a large movement if the interest rate changes expose them to interest rate risk, and sometimes that may lead to insolvency. This is an example of how Treasury bill rates of the United States have fluctuated from 1965 to 2015, and you can see that there has been a significant fluctuation of the rates which range between as high as 16% to almost close to zero in the recent years. Now, you might have a question in your mind that what actually causes these interest rate changes or interest rate movements? Well, while many factors influence the level and movement of interest rates, it is the central bank's monetary policy strategy that most directly underlies the level and movement of interest rates that will impact an financial institution's cost of funds and return on assets. For example, if a central bank smooths or targets the level of interest rates, unexpected interest rate shocks and interest rate volatility tend to be small. The risk exposure to a financial institution from mismatching the maturities of its assets and liabilities also tends to be small. On the other hand, to the extent that the central bank targets the supply of the bank reserves and is willing to let interest rates find their own levels, the volatility of interest rates can be very high. In 2001, I will give you an example from Australia. In 2001, the governor of Reserve Bank of Australia posed two questions. One was, why does the Reserve Bank have to change interest rate at all? Why can't they be left alone? And why does the Reserve Bank have to be involved in the first place? Why can't the determination of interest rate be left to the market? Sorry. Um, the issue underlying these questions is why there is a need for a mechanism other than the market to influence interest rates, and why interest rate changes are not left solely to the market. The Reserve Bank typically has a medium-term inflation targeting as the framework for monetary policy in Australia as well as in the United States, and seeks to achieve the rate of increase in the consumer price index typically between 2 to 3% on average. The impacts on inflation are in the main domestic, but at the same time, the central bank also keeps a close watch on the global economy and global financial markets, as global development could outweigh domestic influences. Now, Central bank's management of monetary policy is not confined to the announcement of a target cash rate, but occurs daily through its open market operations, where it may buy or sell treasury bonds, treasury notes, and sometimes other securities in the secondary market. Through such operations, the central bank influences the money supply, inflation, and the level of interest rates until a target cash rate is achieved. Changes in interest rate that is achieved through the change in cash rate will then impact economic decisions by both businesses, for example, whether to invest or not, or consumers, whether to save or spend. Business investment and consumer spending will stimulate economic activity, whereas a decline in spending and business investment will slow the economy. If central bank believes that it needs to stimulate the economy, it may um, implement a looser monetary policy by lowering interest rates, thereby promoting business investment and consumer spending. Conversely, if there is a need to slow the economy, the central bank would tighten monetary policy through higher interest rates. Um, that's all our discussion about the level and movement of interest rates. We will discuss about the repricing model in the next video. Thank you very much.